Welcome to part one of the webinar, Unravelling the Complexities of Bridging Holiday Lets and Let to Buy, presented to you by Roger Morris. So take it away, Roger.
And we're going to say without further ado. I love that expression, Natalie. Without further ado, what does that mean? But yes, I'll take it away. So guys, in this two-part presentation, we're going to talk about bridging, short-term let, as I prefer to call it. And people say to me, Rog, what's the difference between bridging and short-term let? It's mindset, in my opinion. Holiday lets, short-term let, Airbnb, serviced accommodation will all be covered in that. Let to buy, and just an overview of strategies. But I actually want to really talk specifically at the beginning what we're going to cover for today. We will cover, by the way, sort of taxation and stamp duty, specifically in let to buy. We'll mention on taxation when it comes to holiday let, particularly around VAT. So again, this is purely information for your purposes only, to put you in an informed position, not for you, I, myself, Natalie, Chetwood Bank, to give out any tax advice whatsoever or planning advice. It's just general information as of time of presentation. But what I want to talk to you about is HMRC are constantly running let property campaigns. And I want to give you an excerpt from what the AMI, Association of Mortgage Intermediaries, have given landlords when it comes to checking when dealing with a new landlord for the first time. So let's just say your next customer in has come to you, they are a landlord and they want you to write a mortgage application for them, would be a purchase and remortgage. If you ask them right up front, can I just quantify, are you currently declaring all your income from your buy-to-lets to HMRC? If they say yes, brilliant, proceed. But if they say no, at that particular point, you are legally allowed to walk away without having to do anything else. However, if you submit a mortgage application to a lender and then, because the lender asks for their up-to-date tax return and the client says, I can't give you one because I'm not declaring tax, then you have a legal obligation to report them directly to HMRC. And if you don't, then you are ultimately potentially liable for their taxes owed and due because you've been complicit. So very important, ask the landlord right at the beginning, are they not paying the tax, and make that decision. And that comes from Amy. And the reason I want to talk about this, just for clarity, is we so often hear so much in the news about the government are always taxing landlords and always trying to get as much from landlords as they possibly can. But I don't think that's the case. HMRC are there to ensure the correct taxes are always paid. And I find them nothing more than engaging and supportive generally in what they're trying to do. And let me give you some analysis here. When Newham Council brought in their sort of compulsory licensing scheme, what they thought at the time, there was around about 12,000 expected applications to come in for licensed property within the Newham Council area, about 12,000. When they did the property let campaign, because they wanted to actually understand how many properties in the area being rented out and make sure the standard was of a high quality, they weren't trying to enforce a maximum amount of HMOs. They just wanted to understand what was in there. Turns out there wasn't 13,000. It was actually 27,000. 27,000 properties were being rented out within that area. What they then had to do, which we all have to do, is supply that information to HMRC. And HMRC went through their records, and HMRC established that there was 13,000 of the landlords in Newham County area, the council area, that were not declaring any of their income for tax purposes. So HMRC were able to raise, just off that one licensing area, 115 million in extra tax, 115 million. So HMRC mapped this across the UK at the time to all landlords, and that was an extra 11,500,000,000 pounds. And it was just significant. Think about this. The defence budget was just 36 million. So it was kind of like a significant amount of money. So when we often hear about landlords constantly being hammered for tax, I'd actually say as an industry that at the time they definitely weren't performing and weren't declaring in the way that they should be, as we would be as employees or self-employed people. What we would say now is the reason the government wants everyone to go into limited companies is because that way you can't avoid the taxes that you owed. Hopefully that gives you some context on that. So when we look next about bridging or short-term loans, I like to use the analogy of short-term loans than bridging. If I was in an event now physically attending where we could ask you to all raise your hands instead of a recording, and even on a live webinar, I'd maybe ask a question: who thought bridging was expensive? If we went back 10 years ago, I'd say 90% of the room would say bridging is expensive. However, these days, so many mortgage advisors realizing that bridging is not expensive. First of all, a lot of advisors would incorrectly try and annualize the interest payment or compare it to term lending. So let's just say you were paying 1% a month as an interest rate, that's 12% per annum, where a mortgage rate, a fixed rate, might be 5%. So therefore it is expensive because you're comparing against a 35-year term loan where this might only be a 5-month bridging loan. The lender needs to make the return over a matter of days and weeks, maybe months. But what you've got to do is, when you are purchasing a property of where you need bridging finance, you need to work out what will be the expected profit, return, or reason of buying that property on a short-term loan. How long you will need to borrow that money for, the cost of works for you to then to be able to exit that loan, that bridging loan, that short-term loan, either by refinance it onto a term loan basis or selling the property or having other means to redeem the loan. What you then would look at is the profit and loss of how much money overall, after all expenses, including the cost of bridging finance, you're expected to make. So let's say the bridging loan was 1% a month, and the bridging loan was going to cost you in total, say, £18,000. Oof, that's a lot of money. But if your profit after all expenditure was 200 grand, then it's absolutely not expensive and it's worth considering. It's about working out whether or not the bridging loan, part of a combination of expenditure, is likely to make a profit or not. If it's going to lose money, then absolutely it's the wrong thing to do. But it's literally looking at it as a business finance expense, putting into a spreadsheet and looking at the likelihood of making a profit or a substantial profit is what we're going to cover. So first we start with residential mortgages. The type of bridging loans is needed. So it's whether or not you are using a bridging loan on a residential property and it is classed as a regulated loan, but it's actually done on a short-term basis, not on a term length basis. In other words, it's not for 30 years, it's for 30 months. Then we get buy-to-let finance, which is non-regulated. So it's basically you want to do a bridging loan to purchase a property, or most likely a property that's not in a current lettable state. In other words, it wouldn't meet the requirements of a mortgage lender who was going to put finance on that property to be able to do a term loan because the property wasn't in a habitable and immediately lettable condition. And then there's a classic concept of where bridging finance come from, and we remember it for those that have done CMAP. It's where you are selling your residential home and you found your new dream home. Maybe it's a property in an area where houses do not often come up for sale. And if you didn't get that property, the likelihood of finding a similar property could be years and years from now. And you have enough equity in your current property, enough income, and the ability to do what's called a bridging loan. In other words, you can structure the ability over two properties, your current residential and your new intended residential, and with the current equity position, savings, and the ability to get a mortgage across the two properties, you can consider bridging finance or chain break finance. This is very common, particularly if your current residential property is very lowly geared or unencumbered, and your new residential property is less in value than your current property. Lots of examples of how this can actually work. And second charge loans. So what is a second charge loan? This can be done normally for commercial reasons, and it can be raised against your residential property or your buy-to-let properties. What's a good example of this? A really good example of this, and I remember doing this loan a few years ago. An applicant came to us in August wanting to raise about £500,000, sizable chunk of money, to purchase Christmas trees. They needed to be able to put down a sizable deposit and pay for the full cost of the bridging of the Christmas trees by early October, and the loan would be repaid by early January. So they were borrowing a vast amount of money for some people, but the money that they would make in that period would easily repay that loan and allow them to make a sizable profit. So for them, it was something that made absolute sense. They were borrowing the money on a second charge basis for a small period of time for a fixed, in their words, guaranteed repayment. So why bridging finance? The 5 reasons why bridging finance could be the solution you need. First, number 1 is need short-term borrowing solution. So it's where you, the mortgage advisor, and the lender want to work at record speed. So everything normally involved in a bridging finance is the same as a term loan, but everybody does it so much quicker. So the mortgage advisor would need to supply all the usual proof of income, affordability, loans, the whole process is the same. It works on a normal residential application, but everybody works at a much faster pace. They might want to buy a property to maximize the rental income. So often they're purchasing a property that might not have the current EPC certificate. So improvements need to be made to get the EPC of at least an E, so the property can be rented out. Or it doesn't have a workable kitchen, central heating, or the property is just in a poor state of condition. They want to buy and renovate that property to maximize the rental yield. This is something that I've done successfully for over 30 years. Looking to buy a property at auction. As soon as that gavel goes down in the auction, you've got 28 days to complete. The legal pack would have been there, and you may have done a valuation beforehand. Often I've seen auction properties, the finance go through within 5 working days. A lot of times at auction houses, there is either bridging lenders that have the automatic right to attend and offer their services, but auction finance needs to happen quickly, certainly when you're putting down that 10% deposit that you don't want to lose. And need to raise capital quickly. For instance, the Christmas trees could be paying tax bills, inheritance tax bills, as well as personal tax bills. There could be lots of other reasons. And need finance to buy a property when the chain breaks down. So our classic example, one of my really good friends who lives in Birmingham, lived in an £850,000 house in Edgbaston, and because of health reasons and the recent departure of his wife, who passed away, was able to buy a little bungalow for £180,000. The property just come up for sale, and it was going to go very quickly, and it was right next to his daughter's. He didn't want to lose it, and the ability for what was relatively small cost to take out a bridging finance to be able to, within a matter of days, move into this bungalow, be near his daughter, and he had his own underlying health reasons. The cost of bridging finance was considered and decided it was that small, and the chances of losing that dream property was too much of a risk. So again, sometimes emotional reasons will factor into the cost of short-term finance. So there are three main types of bridging loans. First is standard bridging. This is where a property is in good repair and doesn't need refurbishment. So if you were selling your house, I'd like to think that the property was in good repair, didn't need anything really doing to it, and the property would meet standard mortgage valuations. The property needs some form of refurbishment, EPC, not in a current lettable condition, or heavy refurbishment, where the property needs to have some major work, extension work, or major structural work like underpinning, or where the property hasn't actually been finished off. Maybe somebody was doing a self-build and they didn't actually get through to that property being signed off under building regs. Whatever the reason, they're what you would class as the three major definitions of short-term or bridging loans. This property that I took a picture of at the National Self-Build Renovation Centre in Swindon, if you've never been, I really would recommend you go. It's got houses in all different forms of construction. And so often, certainly when I was a young man, buying a house as a doer-upper, in other words, the ability to go into a property, use your skills. I've got a lot of trades that I'm very good at: bricklaying, plastering, putting kitchens in, joinery. Obviously, I'm not a qualified electrician or plumber, but I can do the hard work to actually lay out cables and put in pipe work, but maybe you get a corky fitter just to fit the boiler. The point being is, in a matter of days or weeks, I can do major works to a property to increase its equity position for the benefit of myself by being able to make money from improving properties. Not everybody wants to do it. Or it could be simply that the property doesn't have the necessary EPC requirements to rent it out legally. And that could be just a matter of replacing the boiler for a combi boiler, putting in double glazing or loft insulation. All these are like for like tax expenditure, energy efficiency improvements. If you buy a property which had a very poor quality kitchen in, and literally it wasn't lettable, but for minimum expense, you could go in and get a basic kitchen, refurbish the property and make it immediately lettable. If you were trying to rent out a property on the left-hand side in an unlettable state, A, the mortgage lender wouldn't lend to you, and B, the letting agent and tenancy would not be forthcoming. This is where bridging really steps in. Now, I can't emphasize enough when dealing with a bridging lender, but also for your own self, about understanding how much you're going to spend. I'd be very specific and really nail down to the fact that whatever you were going to do and whatever your overall budget for the property, you've really worked it out. I would never, if I can help, buy a new kitchen. I'd rather get a second-hand one. I work with kitchen fitters. I work now in Birmingham with a couple of guys, father and son, who've been fitting kitchens for years, and they fit some really high-end kitchens. I'm not going to say the name, but there's a really big showroom in Solihull of this high-end kitchen manufacturer, and they fit the kitchens for this particular brand. So the kitchens they take out normally look brand new. They've just got bored with that, how modern that kitchen is. So by being able to take the units and either maybe replacing the doors, but in most cases, it's just the worktop I sometimes have to replace or buy, and possibly the kitchen sink and taps. I always replace the washers and all the fixtures, because the biggest single reason you'll go back and have to spend maintenance expenditure on a buy-to-let is leaky taps. So just replace the taps and replace all the plastic piping work under the sink, because they're the areas that seem to drain maintenance costs. But then it's about breaking down what's the cost of doing the painting or decorating the hallway, the bathroom, the laundry room, the garage, getting your roof inspected by a qualified roofer, making sure you're not taking on unnecessary work, because the one thing I wouldn't want to do is buy particularly a Victorian property where the cost of refurbishing the roof could be in the tens of thousands. Really make sure that you're looking at this not through sort of glazed lenses, that you're very factual. Replacing windows, again, these are taxable expenses that you can offset in that first tax return, because the like for like, even if it's single glazed, you can put in double glazed. And then the cost of refurbishing the walls, the paint, and the type of paint that you're going to use. I always do advocate more expensive paint, because you might only have to paint it once, possibly twice, not 4 or 5 times, particularly if they've used very unattractive paint, heavy, dark colours beforehand. And flooring, just try and remember you are going to replace that flooring quite a few times if you own a property for a lot of years. So constantly think about cheap, dark, practical flooring. So once you've got this budget mapped out, this then really will give you a great idea. So you're buying a property, you've agreed from this, you're going to spend 18 grand. Next, you want to find out how long it will take and how long you expect to be on bridging. So let's just say the bridging was 18,000. That includes the lender's fee, the service interest, and the time taken. I'm just giving this as hypothetical. That was £36,000. Now, if your profit, so the increase in equity, would be, say, £60,000, then it's worth considering, because there is definitely an upside to this. However, if the value of the property was only going to go up 30,000, you'd have made a loss, and it doesn't make sense. Make sure that with the cost of the total, with the bridging finance and cost of works, makes sense. And obviously you need to include in there stamp duty and legal costs as well. So whether I buy my properties, I can't think how many years ago that I actually ever used my own money. I always try and use the equity acceleration concept. So I have in my portfolio some unencumbered buy-to-let properties. Now, by offering this equity and property up to the bridging lender you're going to use, by saying, right, during the acquisition of the new purchased buy-to-let property, I would like to offer into the underwriting security on a first charge basis of this particular buy-to-let. By offering this up as a first charge and the intended buy-to-let property that I was going to buy as a first charge, it means that you've got a much bigger equity position, therefore a lower LTV, a lower risk to that bridging lender, and it means you'll pay less. So by offering up backup security as a cross charge, certainly puts you in a solid position. Or it could be that you've got a lowly geared buy-to-let, of which you could offer up as a second charge, crossed with a first charge mortgage on the security you're looking at buying for that bridging lender. But if the property you're offering as a backup security is highly geared, then there's no point offering up that security if the indebtedness currently is at 70% or more. So let me give you this in easy to understand terms. The property I'm offering up as a backup property is valued at £400,000, and it's got a 50 grand first charge mortgage, which means the new bridging lender potentially could has £350,000 worth of equity. In other words, if the deal went wrong and I failed to repay, they could force the repossession and sale of that property, and potentially after fees and expenses would get close to £350,000. The new property I was buying was £100,000. I will need the bridging lender on standard terms would offer a 75% gross loan. Now let me explain what a 75% loan is. In normal term lending, normally the bridging lender would offer you net advance £75,000, but in bridging it's normally a gross loan. In other words, on completion of the loan, you wouldn't get 75 grand, 75%. It's normally net down to around 60%. They'll take off lender fees and retained interest. So in a scenario like this, you would need at least a 25% deposit, plus you'd need to also cover off the lender's fees and retained interest. Most bridging loans are done on a retained basis. In other words, if the loan's for 6 months, the lender wants you to pay up front 6 months mortgage payments. That way they don't have to work out any affordability issues. So this purchase is 100 grand. So the lender would be able to take a first charge over the purchase property and a second charge over the backup property. So in effect, they've got 450 grand's worth of equity. Even with the costs of repossession, they'd still be in a positive situation. If what they were asked to do is lend 100 grand to purchase the property outright, maybe cover stamp duty of £3,000, and let's just say refurbishment costs of £18,000, as we saw in the previous slide. Adding that all up, the LTV risks are very positive for the lender. That's how cross-charging works. And that way, as you buy the property, you do the refurbishment, and then what you then look to do is refinance, and hopefully the property's gone up enough in equity to be able to release the charge, or using cash reserves, release the charge on your backup property. So the exits can be refinance by being able to refinance that buy-to-let purchase property, and hopefully it's gone up enough in equity to be able to release without further cash investment both the first charge and that second charge on the backup property. Or you could sell of the security property, sell it on to a first-time buyer and then take out the profit, or even sell the backup property. These are different options that you're able to consider. So at this particular time, Natalie, I think we'll come to the end, and we'll end this first particular part of this particular webinar, and then we'll then do part 2 next.
Perfect. Thanks for that, Roger. So yes, we'll end this one here and join us again for part 2. See you shortly. Bye-bye.